Hello, my name is Rachel and welcome back to my channel. So in today's video, I will be sharing why I will not be investing further in big tech for the next few months. I'm going to give you lots of information and stats and facts and opinions from experts on what you should be doing with investing in tech, and then just talking you through what I have chosen to do. This information is largely taken from my own research and recent publications of Money Week, the Investors Chronicle, and then also from a new working paper from the National Bureau of Economic Research. Now, before I give you more information on why I'm choosing not to invest further in big tech over the next few months, I wanted to share with you what I am doing with my current tech holdings. Because if you've watched any of my videos before, you will know that I'm quite heavily weighted towards the tech sector, and I also have a lot of US stocks and funds as well. So for my existing holdings, I will be doing absolutely nothing. I have been so pleased with their performance. I want to hold on to them. I just will not be investing further in tech specific funds, trusts, ETFs, or individual stocks and shares. So just to give you a bit of information on the current positions that I'm holding in the big tech or tech sector. So I currently hold AXA Framlington Global Tech in my SIP. This is up over 61% since I bought it back in May last year. So I'm so pleased with that performance. So my SIP is my self-invested personal pension. And then I also hold tech specific funds in my investment ISA. My largest holding for a tech specific fund is probably the BlackRock World Global D2 Tech Fund, which I have in my ISA. That has 3-year annualized returns of 37%, so I'm really pleased with that as well, so I'll be holding on to that. Then my most recent purchase for the tech sector was actually the Nasdaq, which I bought, the Invesco Markets Nasdaq. I bought that 5 months ago and it's currently up just over 15%, which is fantastic. And as I said, I do plan to hold this. Most of my investing is in different funds, trusts and ETFs, but I do hold a few individual stocks and shares as well. And of the big 5 tech stocks, I actually only hold Apple as an individual stock, and this is up 29% in my Trading 212 account. And then by default, I'm also holding some of the big 5 tech stocks in some of the funds, trusts and ETFs that I'm invested in that aren't specific to tech. So an example of this is the Scottish Mortgage Investment Trust currently has Amazon as its number 10 holding within its top 10 holdings. So for those, I am really happy with their performance. I want to hold on to them. I did a lot of research when I was deciding to invest in them, and I still think that they're good investments, and I plan to hold on to them. I will not be selling my existing tech investments. I tend to invest for the long term, and when I make an investment, I plan to hold it for at least the next 5 years. So I'm not selling any of my existing tech investments. However, as I said, for the next few months, I will not be investing further in big tech. There is a lot of conflicting information on whether you should be investing in tech at the moment, whether it's overpriced, whether actually tech is at a fair price at the moment. There's so much information, lots of new research coming out around it. So in this video, I wanted to share that with you in the hope that you find it interesting. It's not one-sided by any means, but for me personally, as I wouldn't consider myself an expert or a pro investor, I would still consider myself a beginner because I have only been investing for the last few years. So for me personally, while I try to figure out and understand exactly what's happening in the market, I prefer to personally not increase my tech holdings at the moment, but I might review this in a few months and change my mind. So the first argument that I'm seeing a lot of at the moment as to why you shouldn't be investing in tech is because that it is overpriced. I've also seen arguments to say, which I will be including in this video, that actually they're all at a fair price. But basically the crux of people thinking that tech stocks are overvalued at the moment comes largely down to the fact that the tech-heavy Nasdaq index currently has a 12-month forward PE ratio of 31, whereas 5 years ago its PE ratio was 20. So compared to 5 years ago, it is very expensive. However, a lot of experts are saying companies like Alphabet and Facebook have seen exceptional earnings growth and are worth the price that they're currently sitting at, and that they are not overpriced. And a lot of people are saying that tech is more important now than ever. So Walter Price, who is the manager of the Alliance Technology Trust, has said that a decrease in global birth rates and pending labour shortage will force companies to invest in technology to boost productivity. He says that we are in a period of rapid change where solutions such as cloud, software as a service, artificial intelligence and cybersecurity are key to the prosperity of most industries. So this definitely gives me some confidence when I'm thinking about whether I want to be holding on to my current tech holdings. And then another important factor to consider when you're deciding whether you want to invest in tech is the impact that low interest rates has had on the tech sector. A new paper from the National Bureau of Economic Research has said that low interest rates have had a critical impact on these big tech companies. So in their paper, Falling Rates and Rising Superstars, they have analysed market data going back to 1962. They compared the market performance of companies in the top 5% of their industry, with the returns on a portfolio consisting solely on their smaller rivals. They found that when interest rates were falling, the dominant companies outperformed. Falling rates disproportionately benefit industry leaders, especially when the initial rate is already low. So why is this the case? Industry leaders are able to borrow more cheaply and in greater quantities than their smaller competitors, so they get more benefit from falling rates. In turn, this means they can buy back more shares and also leverage up their balance sheets, both of which tend to boost valuations while rates are falling. Privileged access to cheap money also means they can invest in expansion or in buying rivals more easily. In effect, lower rates give leading companies the ammunition to entrench their dominance. So what does this mean in practice for investors? If falling rates have boosted valuations of the biggest stocks on the way up, it implies that they may struggle if rates rise, particularly as this would mean investors place less of a premium on future earnings. So if inflation isn't transitory, even central bankers are finding this argument hard to sustain. Betting on big tech and by extension the US market in general may no longer be such a sure thing. So what does this mean for my own personal investments? For me, this means that I want to hold on to the existing tech investments that I have. I'm also very heavily weighted towards the US market as well, and my biggest holding being the Baillie Gifford American Fund. This does make me feel slightly nervous, and for this reason, I'm out. No, that's a big old dragon's den. No, for this reason. Sorry. I'm currently not investing any further into big tech companies and tech companies, and then looking at other options of things that I might want to invest in. So at the moment, my focus will be on holding these existing investments and seeing how they're doing, and then investing in other sectors and other areas. So you will see from my other videos that I'm also invested in things like clean energy, healthcare stocks. So I have got other sectors that I'm interested in investing in, and I would like to take this a step further and look at other areas that I might want to invest in as well and diversify my portfolio a little bit further over the coming months. As I said, a lot of the information was taken from various books I've read, The Investor's Chronicle, Money Week, and also from the working paper from the National Bureau of Economic Research. So I'll pop links to all of those down below. None of them are affiliate links, they're just for your information in case you wanted to have a look. Thank you so much for watching this video, and if you fancy subscribing, I would love it. I'm getting closer to 900 subscribers, and I would love to be at over 1,000 subscribers by the end of the year. I really appreciate all your support because, as I said, I am just a beginner trying to figure out what I'm doing with all of my investments as I go. So I hope you find these videos useful and interesting, and thank you very, very much for all your support. I genuinely mean it. Thank you. Bye bye.